Hello, I'm Nicholas Hyatt, Investment Manager here at Wealth Club, and today I'm with Simon King of Octopus Ventures to talk about the Octopus Ventures EIS service. Simon, for those who aren't familiar, would you mind telling us a little bit about Octopus Ventures and about your own background?
Of course. So Octopus Ventures is part of the wider group of Octopus companies that includes trusted brands like Octopus Energy. Octopus Investments, of which Octopus Ventures is a part, has been investing in tax-efficient products like EIS and VCTs and inheritance tax products for the last 20 years or so. So Octopus Investments has about £12 billion under management, and within the ventures team we have about £2 billion, and we've been investing in early stage high growth potential companies for the last 15 years within the group. Personally, I have been with the team for the last 11 years. I've actually got a background as a scientist, so I studied physics, chemistry, materials, and then joined straight out of academia 11 years ago. And so within Octopus, I'm responsible for investing in the kind of deep tech companies, so the IP-rich spin-outs from universities, really kind of technology-heavy companies, which is what I enjoy and what's kept me at Octopus all this time.
So what does the Octopus EIS service aim to deliver for investors, and how many companies can investors expect to be invested in?
Of course, yeah. So we have two EIS products. We have the Octopus Ventures EIS Service, and we have the Knowledge Intensive EIS Fund. And really, what we're trying to do with these products is to invest in very high growth potential companies at an early stage, something that we've been doing through Titan VCT, for example, for the last 15 years, but in this case provide EIS tax reliefs to the underlying investors. So typically within a tranche of the Octopus Ventures EIS service, we're going to be looking to invest in between 10 and 15 companies.
So how does the EIS service and the knowledge intensive service differ? What are the key differences between the two?
Yeah, of course. So the Ventures EIS service is open most of the year round, and we are then investing into the various companies that we see. The knowledge intensive EIS fund will specifically invest in companies that are classed as knowledge intensive by HMRC, which means they're often richer in IP and doing more research and development. It's also quote unquote a fund, right, in the sense that the tax reliefs that investors can claim under EIS come when we close the fund rather than at the point that we make the investment, which is what happens with the Ventures EIS service.
So when you're investing in a company, what are the key things you're looking for?
Yeah, so first and foremost, we're looking for disruptive companies that can grow to be worth multiple hundreds of millions, if not billions. In order to do that, we're looking, first of all, at a number of different sectors that we think are very exciting. So, as a ventures team, we're one of the largest ventures teams in Europe, and we're a generalist made up of specialists. So, as I mentioned, I focus on deep tech, kind of IP-rich opportunities, and several of my colleagues have PhDs in different fields. But equally, I work alongside teams of people who focus on fintech, financial service technology companies, or health tech, or biotech, or B2B software type businesses. And because we're kind of a team of 35 or so who are investing the Ventures EIS Service Knowledge Intensive EIS Fund, we break ourselves down into these little specialist groups, and we can seek out the absolute best opportunities in each of those different areas. Once we have found one that we think is good, we go through a pretty intense diligence process, and we're really looking for three things with those companies. First and foremost is the team. Why does this team have the background, the skills and the experience to be able to build a successful business in this particular sector? Personally, I'm looking at the CEOs and the founders of these organizations and trying to understand, can they sell? Because they're going to need to sell to three groups of people. First, they're going to need to sell their products to customers. Second, they're going to be able to sell. They're going to need to sell their equity to investors, and that might be us. But often there are further funds, further rounds of funding after we've invested, so they're going to need to be able to sell, on an ongoing basis, the equity in their companies. And third, they need to be able to sell to employees. In order to make these businesses successful, you've got to be able to attract the absolute top talent, which often means attracting them out of cushy, high-paying executive jobs into a risky, high-potential startup, and that takes a lot of sales prowess. So that's the first thing we look for. Second is big markets ripe for disruption. So when I say big, we're looking for opportunities and companies that can grow to be worth hundreds of millions or billions at exit. In order for that to be the case, these companies have to be able to generate hundreds of millions in revenue, which means they need to be targeting markets that are worth in the billions. Finally, we're looking for unfair advantages that these companies have. Why does this company, based in somewhere in the UK, why can this succeed where all the other startups and companies around the world, or potentially the big incumbent players, are not going to succeed? So we're looking for unfair advantages like patented technologies that have come out of universities, or unfair access to a particular customer base, for example.
So you're looking for great management, great markets, and that kind of unfair advantage. But how do you go about finding those companies? Yeah,
great question. So at the typical stage that we're investing, there are many more companies than there are investors. And so actually a big part of how we source our potential investments is they come to us. And they come to us because we have that 15-year track record investing in early stage venture companies. We have built and sold successful companies that are household brands now, the likes of Zoopla, the likes of Depop that was acquired by Etsy a couple of years ago for $1.6 billion. And so entrepreneurs, especially the top entrepreneurs who have their potential pick of funding partners, they're looking for who am I going to take money from, who's going to help me the most, and who has a successful track record, and so they seek us out. But also on that kind of 15-year journey, we've built a network of service providers, co-investors, funds that operate at the level below us, who know us, understand what we look for in an opportunity, and are able to share investments. And all that means is that we typically see, give or take, 3,000 businesses per year. We will then meet with several hundred of those and invest in approximately 30 per year.
I think it's fair to say as well that you often back managers repeatedly. So a founder might found one business and then they potentially found another, and you'll look at them again.
Yeah, absolutely. A great case in point would be we backed a business called Graze early on. So you can now buy Graze snacks in your local supermarket. They started off as a subscription business where you'd buy a kind of subscription to the snacks. Some of the management team after that business was acquired went on to found a business called Tails, which was a direct-to-consumer dog food business. That business was then acquired by Nestle, and a subset of the management team and the investors went on to found a next business called Skin+Me, which is a kind of digital pharmacy selling kind of skincare products on a subscription basis. So you can see the theme between each of those, and each time those management teams have come back to us for investment because we worked really well with them at each of the different stages.
So what does the typical Octopus deal look like? How much are you putting in and how big is the round size?
Yeah, so we're typically investing at the Series A stage, which is horrible industry jargon, but basically means companies that are loss-making at the point that we're looking at them, but they will typically be generating a little bit of revenue. It's very dependent on the sector. And small teams, order 10 to 30 people or so, and they're really looking to take outside investment capital to help develop their product, develop their go-to-market strategy, and continue to scale their sales going forwards. So typical round sizes that we see are between £2 to £3 million up to 15 to 20 million pounds at the top end, and we are investing anywhere between £1 and £10 million in those companies. So the average check size that we've written into businesses over the last 18 months is about £4 million. But one thing to remember about the EIS products is that they co-invest alongside some of our other funds, so Titan VCT, for example, or the Future Generations VCT. So actually the investment from the EIS products is smaller into each of the different companies, but they're supported by the other funds that we're investing alongside it.
Obviously, the market's changed a lot in the last 18 months to 2 years. You've seen interest rates go up, inflation rise dramatically.
Yeah.
Has that changed the way you invest at all?
A little bit, yes. I mean, it's definitely a very different market than we've seen over the last, a couple of years ago. I think the first thing to note in terms of the companies themselves is that we're investing for equity, and they typically don't take debt. So the companies themselves are not exposed to the interest rate environment that much. But obviously, as interest rates have risen, equity valuations of companies have come down, just due to supply and demand in terms of the capital that's available. And what that has meant for us is there are now great entry prices when we're investing into these companies. So if you have capital at this stage, I think it's a fantastic time to be investing in these early stage businesses. And the second point to note is, in times of the greatest kind of economic uncertainty, we have seen some of the best companies created, Uber, Airbnb, Stripe, all created, and multi-billion-dollar, if not tens of billions of dollar companies, all created in 2009, 2010, after the last financial crisis. And part of the reason for that is, lots of people have this idea at the back of their mind that they want to be an entrepreneur, they want to create a business, but there's nothing more addictive than a paycheck. And in times like these, unfortunately, people lose their jobs, and that's sometimes the impetus they need to go out and start something they always thought they wanted to. I think the other factor that's playing into it is, small, early-stage, nimble companies can take advantage of opportunities in a way that really big companies can't. If you want to change the direction of your company overnight, you can only do it when you've got 10, 30 people. If you've got 10,000, it's a much bigger operation. And so, when entrepreneurs spot opportunities in early-stage companies, they're able to take advantage of them in a way that big companies just can't.
Could you talk us through a couple of recent examples of companies that really hit that spot for you?
Yeah, of course. So a great one is a business called Kita. So it is a carbon insurance business. And what I mean by that is, at the moment, there are many companies trying to offset their carbon footprint by buying carbon credits. And as a result, we've got much higher demand for carbon credits than there is supply. And the supply is typically made up of projects like tree planting, kind of reforestation, or potentially directly taking carbon dioxide out of the air with new technologies. And at the moment, because of this imbalance in supply and demand, there's not enough capital going into building the sort of projects, because people are worried that they may fail for one reason or another. So people are not buying the carbon credits because they're worried about whether these projects are going to be delivered in the future. And what Kita does is provides an insurance solution so that anybody who's buying carbon credits can have peace of mind that if, for whatever reason, the projects, the carbon credits that they've bought into don't materialise in the future, there's an insurance that will help support them. And as a result, Kita's hoping to unlock massive financial flows into these projects, which is critically needed to stem the climate crisis. Fantastic business invested by some of my fintech colleagues, where we have a great track record in insurtech companies, and the business was founded by a set of serial entrepreneurs and insurance experts. So, great company.
And how about those more mature companies that you invested in a while ago? How are they getting on?
Yeah, of course. So obviously a mix of different businesses that we've invested in, and we only restarted investing EIS products in early 2021. But a great example of a company that's doing fantastically well at the moment would be Taster. And so Taster is a digital restaurants brand, and it was started by the early employees from Deliveroo. So it's a kind of a delivery-only restaurant brand. You won't find any restaurants out there on the high street, but if you go onto your Deliveroo apps or Uber Eats apps, you will find their restaurant brands. And it's a business we invested in early 2021. They've now raised more than 40 million. They're operational in 3 countries. So it's absolutely flying at the moment. It's the way that people are buying food these days.
And how involved do you get in companies that you invest in? Is it just give them a check and leave them alone, or are you much more in the weeds than that?
No, we're pretty hands-on with these companies. So typically we will take a board seat and work directly, with the rest of the board and the management team on the strategy at the businesses, and that helps leverage our experience and the team that I work with to get their experience into these companies. And there are areas where we can be very helpful. For example, a serial entrepreneur, they may sell 2, 3, 4 businesses in their lifetime. We're in the business of selling companies, and so we've sold dozens and dozens. And so when it comes down to having those exit conversations, who's going to buy this business? Are we going to go for IPO? We have the experience to be able to inform the strategy of the companies going forwards. But alongside that direct experience that we can provide, we also have a suite of different services that we bring to bear when we're making investments in these companies. So a good example of that would be my colleagues who are our talent partners. And so they are a group of 6 individuals who purely work with the portfolio on all their people-related issues. So we firmly believe that if you have the best people in the business, they're going to have the best chance of success. And how do you get the best people in the business? Well, you have to get the right hiring structure. You need to be able to retain those people, so offer the right benefits and perks to them. You need to know how to remunerate them. So what are the benchmarks? What's good, what's upper quartile, what's lower quartile? And so what that group of individuals do, they can help the businesses, formulate their hiring strategies, their retention plans, their option plans, in order that they can hire and retain the best people. It's a great example, and the kind of skill sets among that team are phenomenal. So a colleague I work with very closely, a guy called John Durnford-Smith, he led all the applied AI engineering hires at DeepMind before joining us, and before that he was at Quantum Black, which was a McKinsey company. And so he gets really stuck in with the businesses to help them find the best people and then make sure that they're performing at their absolute utmost.
So the EIS fund is still quite young in venture capital terms, but have you had any exits from other funds that you could talk about to give us a flavour of how good looks? Yeah,
of course. So we sold 13 businesses in 2021, another 4 in 2022. I've mentioned some, so the likes of Depop, which was a kind of mobile marketplace really for second-hand clothes that Etsy acquired for $1.6 billion a couple of years ago. Or on the Deeptech side, we sold a business called Wave Optics, which was building augmented reality glasses and displays, which will turn glasses like this into something where you overlay a digital picture on top of reality and kind of add to it, which is widely believed to be the future by the likes of Meta and Google. And that was acquired by Snap for more than $500 million 2 years ago as well. So as you say, it's still early days for the Ventures EIS service and the knowledge intensive EIS funds. So we only started investing at the beginning of 2021. So we're not yet through the kind of 3-year period you'd like to see before you start selling those companies.
Investing in early stage businesses is always risky.
Yeah.
How do you think about the proportion of companies that might not make it when you invest?
Yeah, well, as you say, there is a high risk, high reward game that we play, and as a result, we will see failures. And if we didn't see failures, frankly, we're unlikely to see the outsized successes like the exits that I've just mentioned. So typically at the stage that we're investing, we would expect 30 to 50% of the companies that we invest in to return less than the capital that has gone into them. Obviously for EIS investors, they may well have the potential to claim loss relief on some of those. But that's counterbalanced, the losses by the potential upside, obviously, from investing in the great companies where instead of just returning 1 times or 2 times your money, you might get 10 times your initial investment.
So Simon, to sum up, if I was going to invest in a single EIS fund this year, why should it be the Octopus EIS service?
Sure. Well, I think if you are looking for the EIS tax reliefs, you're looking for a manager who knows what they're doing when it comes to investing in early stage, high growth potential companies. And that's what you get with Octopus. As I say, we've been doing this for 15 years. We've got the largest venture capital team in Europe. We have built through that time the experience and the expertise to be able to find, invest in, help to grow, and then exit some of the most valuable and exciting ventures in the UK. I think alongside that, we have aligned our fee structure with investors as well, so we won't take an annual management charge on money that's invested until we see profitable exits from the service.
Simon King of Octopus Ventures, thank you very much.
Thanks very much, Nick.
If you're watching on YouTube, please press like and subscribe to the channel for more.